This is the most exciting video of this channel. Today I'll be talking about 3 long-term investing strategies and how you can apply them using just one website. Let's go. First, coffee can investing. The coffee can strategy was first introduced by a financial advisor called Robert G. Kirby in the late 50s. However, in India, this became very popular because Saurabh Mukherjee's best-selling book, Coffee Can Investing, The Low Risk Road to Stupendous Wealth. Coffee can investing refers to a buy and forget strategy where you buy some stocks and then you forget about them for at least 8 to 10 years. Primarily, coffee can investing is a long-term investing strategy for passive investors who want to just buy stocks and then don't want to think about it for a very long time. By doing this, you are saving a lot of your time, plus you don't incur any charges such as taxes, brokerage, because your churn is absolutely zero. But now, how do you screen stocks which you want to keep for the next 10 years? The metrics used in the coffee can investing are: number one, revenue growth. Every company is trying to sell something. Asian Paints is selling paints, TCS is selling their IT services, and Maruti Suzuki is selling their cars. Now, to see if the company is actually doing well, we should check if a company's sales are growing over time. So the first metric is your 5-year revenue growth should be at least more than 10% on an average. Next is return on equity and return on capital employed. These are profitability ratios which basically tells us how efficiently a company is using their shareholders' equity or total capital to generate profits for the company. Return on equity is net income divided by total shareholders' equity, while return on capital employed is earnings before interest and taxes divided by total shareholders' capital. अब सिर्फ ROE देखने से आपको पूरा पिक्चर नहीं मिलेगा क्योंकि आपको डेट का आइडिया नहीं मिल रहा, इसीलिए ROE और ROC दोनों को देखना चाहिए. So here the filter is more than 15%. तो कोई भी कंपनी जो ROE और ROC 15% से ज्यादा दे रही है, वो सारी कंपनीज कॉफी कैन स्ट्रेटेजी में फिल्टर आउट हो जाएगी. And finally we'll select companies which have a market cap of at least more than 5,000 crores so that the small companies which have unreliable information are removed. Now it's almost impossible to individually select 5,000 stocks and screen through all these metrics, and that's where Tickertape screening tool comes into play. Just go to stock screener. Now first filter out companies based on market cap. तो यहाँ पे 5,000 करोड़ लिख देते हैं. Okay, so out of 5,000 companies, we are now left with just 500 companies. सही है. Then we'll go to revenue growth. Click on 5-year historical revenue growth. So here we'll get the revenue growth rate of all the 500 companies. But we only need those companies which have a revenue growth of more than 10%. So I'll add this filter. As soon as I put the revenue growth filter, 50% of the stocks are gone. Next, I'll put ROC and 5-year average return on equity. Here, ROC more than 15%. The ROC filter has removed almost 100 companies. Then I'll also put the filter of 15% ROE. Now, after putting all these filters, we are left with 121 companies. We started with 5,000 companies and now we are just left with 2% of the total companies in the stock exchange. Now, you should not invest in 120 companies. So what you should do is individually read about the companies, get an idea, then figure out which businesses you understand. So let's say you are from the IT sector and you understand how the IT companies work, what their margins are, what the attrition rate in each of the companies are. In that case, you can invest in an Infosys, HCL Technologies, etc. By the way, guys, none of this is financial advice. So always do your own research before studying. Similarly, if you're in the steel business, then you can first start analyzing JSW Steel and then go ahead and research about all the other companies. So here I'll save the screen. Coffee can investing. First method done. Next, we have Warren Buffett's investing style. Popularly known as the Oracle of Omaha, Warren Buffett is hands down the most popular investor in the world, and he falls in the top 10 richest people in the world. Imagine he has managed to become a multi-billionaire by just investing. He's a long-term investor, and in the words of Mr. Buffett himself, the best holding period for an investor is forever. In fact, Warren Buffett started investing at the age of 13, and he once said that he was 13 years late in starting his investment. Now, the first thing that he looks for is durable competitive advantage. He believes that this is something which gives the company an edge over all its competitors, and this can be achieved via anything: a strong brand, strong supply chain, competitive pricing, or a wide distribution network. For example, Coca-Cola sells 8 billion 300 ml servings every day. So if one day they decide to increase the price of Coke by just 1 rupee, their daily revenue will increase by 800 crores. That's Coke's competitive advantage, guys. Their wide distribution network and a very strong brand presence. Also, he analyzes the long-term economics of a sector, because no matter how efficiently a company is running their business, if the economics of that sector is not favorable, then in the long run, that company will not be profitable. Warren Buffett often says that the quickest way to become a millionaire is to first be a billionaire and then invest in an airline business. Mr. Buffett likes to use these following metrics to screen his stocks. First is net profit margin. If a company has a net profit margin of more than 20%, it is a sign of a durable competitive advantage. Next is current ratio, which is basically current assets divided by current liabilities. This metric tells us the company's ability to pay off their short-term obligations. He wants companies with a current ratio of more than 1.5. Warren Buffett does not like companies which are overly leveraged and have very high debt on their books, and that's why the third metric is debt to equity ratio. He likes companies which have a D by E of less than 0.5. And finally, the last metric is return on equity. He believes that a company which is able to consistently deliver an ROE of more than 15% is efficiently executing their operations. It's time to make our second screener. First filter is net profit margin of more than 15%. I click on the 5-year average net profit margin. As soon as I do that, more than 4,000 companies are removed. Next, we have current ratio. Here again, I'll put the lower threshold of 1.5. 100 companies are now removed. Next is debt to equity, which should be less than 0.5. I think as soon as I put this filter, a lot of companies will be removed. We are just left with 150 companies after this filter. And the last filter is 5-year average return on equity. And this should be again more than 15%. After putting these 4 strict metrics, we are left with less than 50 companies. Now you know what to do, guys. Do not blindly invest in these companies. First, read up about them, figure out if you can understand their business model, and then if you like what they do, go ahead and invest. But you have to do your own research. And the last strategy of the day is the magic formula. The magic formula became very popular because of a book by Joel Greenblatt, The Little Book That Beats the Market. Joel Greenblatt is the founder and the former asset manager of Gotham Capital. This technique is a relatively simple and easy to understand method for value investing, and Mr. Greenblatt claims that he generated a returns of 30% by using this formula. Now guys, 30% is no joke. You have to take it with a pinch of salt, and that's why do not put all your money in this strategy. First, do your own research, understand it, and then figure out if this is for you or not. Anyway, the metrics are: set a minimum market capitalization of 500 crores. Second, we look at the PE ratio. PE ratio basically tells us how much are we willing to pay for 1 rupee of the company's earnings. So if Reliance share price is 1000 rupees and its earnings per share is 20, then the PE ratio will be 50. Generally, higher the PE, the more overvalued the company is. But of course, do not just look at PE and make a conclusion. You have to look at a lot of factors. You have to screen out companies that have a PE of less than or equal to 5. In today's day and age, finding companies with a PE ratio of 5 is actually very difficult. Lastly, the magic formula looks at the return on capital employed. The ROCE should be at least 15%. First, we put the filter of market cap, more than 500 crores. Okay, 3,000 companies are gone. Next is PE ratio, which is less than 5. Oh my God. I have no idea kitni companies bachengi. 49 companies. From 1200 companies, we are left with just 49 companies. And the last metric is ROC, which should be at least 15. Okay, so now we are left with 31 companies. Here are the next steps of magic formula. So if you have a pro subscription, you can basically export all this data in an Excel sheet. After that, rank these companies from highest to lowest. So in this case, Vardhaman Holdings has the lowest P ratio. So they'll be 1. Steel Authority of India Limited will be 2. Whereas this company will get the 31st rank. Next is ROC. Sport King will get 1. Hindustan Construction Company will get 2. Whereas Uflex Limited will get the 31st rank. Now, after doing this, add both the ranks. Let's take the example of Vardhaman Holdings. They got the rank 1 in terms of P, and here they are 27. So their cumulative ranking will be 28. So now you have to select the top 5 to 7 stocks based on the lowest cumulative rankings. Of course, guys, lower the rank, always better. Now invest 20 to 30% of your total capital in these 5-7 stocks. Then repeat step 1 to 3 for every 3 months. So after 3 months, you have to again do this ranking, and whichever 5-7 companies have the lowest rank, you again put put 20-30% in those stocks. You then have to sell these companies after holding for more than 1 year. Repeat this process for 5 to 8 years, and Joel Greenblatt is saying that this process will give you more than 30%. This is one of those investing strategies which is not for passive investors or casual investors. You need some time and effort to figure out this process. Alright guys, that brings us to the end of this video. If you found anything valuable in these 3 strategies, then please hit the like button. If you are new here, then consider subscribing. Also do check out Tickertape subscription. It is cheap and it really makes an investor's life easy. This is Anshuman Sharma, and I'll see you guys in the next one.